You mentioned a little bit earlier about the European sovereign debt crisis. There has been a bailout plan that's been implemented for Greece, but let's talk a little bit more about Europe as a whole. Since we last spoke in July, again, the EU leaders agreed to a 109 billion euro assistance plan for Greece. In addition, the ECB has begun to buy Italian and Spanish government bonds to stabilize borrowing costs. What are your thoughts about these actions? Are they strategies that will work in the long term? Are they just temporizing strategies that kick the can down the road? How do you think that the European leaders should address the underlying problems of the stalled economic growth in addition to this excess debt?
They are temporizing solutions. They are kick the can down the road solutions. We have yet to get to a serious set of solutions that will actually put in place a permanent fix. But let's review again what's happened. Events have just unfolded at a very rapid pace. It was less than a month ago that Greece was seemingly on the edge. It's now not even in the newspapers any longer. It's been overtaken by events, and that's because, as you said, the solution that the Europeans came up for Greece, the 109 billion euros, actually keeps Greece out of financial markets for 2 years. They don't have to go back to the markets to raise debt. They're taken care of, and so it doesn't matter what happens to Greece at this point. They're out of the picture. But the solution itself actually sowed the seeds of the next phase, because part of the problem here that we've been talking about right along is when you have too much debt, which Greece obviously did, and you can no longer finance it, or you can only finance it at interest rates that simply drive the debt higher, you ultimately have a solvency issue, and that means somebody's got to take a loss. And so that was part of the solution on Greece, was who takes the loss. And part of the loss was actually pushed back on bondholders. And that was done in an indirect way by rescheduling the debt. So here I have a piece of 2-year Greek debt. Now I'm going to take a 30-year bond at a reduced rate of interest. And anybody that has taken a basic course in finance knows the present value of that means you have something that's less valuable. You've undertaken a loss. You've absorbed a loss. That was not lost on investors, all right? And almost as soon as the ink was dry on that agreement, the speculators started attacking Italian debt. Now, why Italian debt? Well, because Italy has got a pretty dysfunctional government right now. It has a very high public debt to GDP ratio, and it has almost no growth. And so it becomes sort of, well, if there's a next domino to fall, it would be a likely candidate. So let's get out of Italian debt. And that's what speculators started doing, and the interest rate on Italian debt crept up, and it crept up, and it crept up, and it crept up. Got to the point where it looked like there could easily be within days a financial market riot that would create an untenable situation for Italy. So the ECB came in and did what Jean-Claude Trichet said he would never do, but now they're doing it, is they're buying Italian and Spanish debt. Well, the immediate effect of that was to drop the interest rates from over 6% to around 5%, which I might add, to 5% still is more than 200 basis points above German bonds. Okay, so yes, it reduced the rate, but it certainly didn't put them in the same class as a AAA credit. That's part of the problem, is that now the Europeans, just like in the US, are going through this reassessment of, well, where does the economy go? And it looks like it's going to be slower growth, maybe even recession. Certainly that's the case for Italy, probably as well for Spain, maybe even some of the other European countries as well. And as I said earlier, whenever you have cutbacks on government spending with the attempt to reduce the debt, and you have a downturn in the economy, that is a toxic mix that doesn't work particularly well. Because you may reduce the debt, but if you reduce the GDP faster, you haven't changed the debt load, and maybe it even gets worse. That's what happened in Greece. It could happen in Italy. Well, who holds those Italian and Spanish bonds? Well, mostly European financial institutions. And so we've, in the last few days, seen yet the next leg of this, which is a liquidity crisis for other European financial institutions, in particular French banks, and among French banks, Societe Generale has been the focus of attention. And the reason for that is if indeed there is a haircut of the sort that occurred in Greece, guess who it hits? And at some point you have to say, well, is there a solvency issue? Is there enough capital? And remember back to 2008 in the United States when we solved this solvency problem by passing TARP. Now, TARP was a matter of socializing all the debt, bank debt, and it was successful at least for a period of time. We're now in a period of testing to see again whether that's the case. But in the case of Europe, now I'm going to get to your question. Where does this go? What should European policymakers do? First of all, temporizing, kicking the can down the road, just extends out the problem. It will get worse. It will come back. It will have another episode. We've seen this on a sequential basis. Where it ends, I'm not sure. One place it could end would be to have a physical union similar to what exists in the United States. But that would mean each of the members of the European Union giving up their sovereignty, all right, over a great deal of things. And the question is, can you get from here to there? But if you had a fiscal union, then you would have the collective support of the entire 17-member nation economy, issue Euro bonds. You replace the Spanish debt and the Italian debt with the Euro bonds, and it becomes the obligations of all of them collectively rather than the individual countries. The alternative, if you can't get from here to there, is that you continue to stumble along, you continue to have half measures, you try to contain. Again, I'm not optimistic that that produces good results in the long run because it will depress economic activity and become self-defeating in that sense. The other alternative is what we call, fancy word, devolution, or a busting up, to put it a little bit more graphically, of the European Union and going back to nation states.
Are any of these alternatives more likely than another? Absolutely. Okay. Well, I'm sure we're going to revisit this